Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Coming into this morning's U.S. jobs print, analyst expectations were a bit all over the place, actually. Another sign that although perhaps past peak uncertainty, markets and expectations are volatile. New ways to provide ballast in one's portfolio are worth considering to help steady the release of both data and also policy shifts across the board, and to help you take a much longer view. Joining us today to discuss Fidelity's alternative investments, both liquid and less liquid, is Director of Alternatives, Rory Poole. Welcome. Great to see you, Rory.
Thanks, Pamela. I realized that based on my title, probably the alternative that I need right now is an alternative for my wardrobe, because the slide that they showed at the beginning of the presentation, I'm wearing the exact same outfit that was taken in that picture 2 years ago. So while we're here to talk about different types of alternatives today, appears I can't escape the term.
You'll have to go shopping. But in any case, it's a very good outfit, so there's no reason not to be wearing that. Let's begin with just the example of today. So the jobs data comes in. The question, of course, is whether rates do or don't get cut by the Fed. What does this mean? It's a discussion. It's a live discussion. Take us to where this type of volatility and anything else can be perhaps just better balanced in a portfolio with an alternative fund. And I'm kind of looking at this as if it fits on the bond side of a 60-40. Just tell us a bit about that. We might talk about it.
Yeah, there's a few pieces we can probably unpack there, but getting directly to the first point that you mentioned with regards to like the bond market and the jobs number this morning and how those things are potentially related. I think that we had a strong print this morning. And as a result of that, I think the market would assume that we probably won't get a rate cut in the U.S. For at least the summer. It'll probably push it into the fall, at which point I believe, as of most recent, they're pricing in about 2 rate cuts before the end of the year. Whether we get that or not, who knows? That's obviously going to impact performance within the bond market. As a result of that, yields this morning have crept up a little bit. But kind of layering in the whole where does an alternative fit, or why now, or some collection of all of those things. On top of that, you also have the fact that like equities in a lot of places that you look are suddenly like wake up, it's whatever, July, and they're back at all-time highs again. Yeah. And so I think that if you think about it in that way, in terms of the two major pieces of most people's portfolios, you layer on top of that the fact that we're going through all of this like continued political turmoil, some geopolitical tensions that are occurring. Like, if you want a way to potentially drown out a little bit of that noise within a certain pocket of your portfolio, whether that is the bond portion or the equity portion or some combination of the two, alternatives are certainly a great place for people to look.
And why are they? Like, what is it there that they are providing? So in a lot of cases, they have the ability to do short selling, the ability to go longer with maybe more conviction. Just take the pieces there apart for us, why this can help.
Yeah, well, the investment universe is huge. And it depends. Like, you're referring to more specifically like the liquid alternative market, which what I call kind of like hedge fund light type products. So within our lineup, that's the Dave Way long short alternatives. That's the Brett DeLay market neutrals, the Dan DuPont global value long shorts, the Ritu Kumra Canadian long short alternatives. And essentially what they do is they still use liquid underlying securities within the portfolio, but that they have these additional bells and whistles from a toolkit or portfolio management standpoint, where they can either increase the potential to generate return within the portfolio, or have additional mechanisms as to which they can actually preserve capital further. So it's really just these additional measures that allow these products to take on a little bit of a different type of behavior potentially in certain market environments. And I think that if we rewind a couple of months ago to the drawdown that was experienced within really all equity markets from whatever was February until kind of beginning mid-April. If you look at the liquid alternative market, so we're just talking about these funds that use liquid underlying, you probably had 90+% of those funds outperforming the market over that drawdown period, and in some cases to a significant degree, and in other cases to a degree, they're actually generating return in a period where the market is falling at a pretty rapid rate. And so that kind of speaks to the whole argument, evergreen argument within alternatives of diversification and so forth. And then if you look at what I would call the other part of the alternatives market, at least through the lens of different types of investors, is what most institutional investors think of first and foremost, which are illiquid assets. And those really don't have any kind of first order impacts or any first order sensitivity to what we experienced in the first part of the year.
So there's sort of degrees of diversification, just even speaking broadly about liquid versus illiquid or less liquid within that. So it can provide diversity for you in a falling market, for instance, but also just due to the fact that it doesn't have to be priced daily, for instance, in something that's more
in some
illiquid.
cases, yeah, definitely with the illiquid stuff. There's a lot of empirical and academic evidence of the fact that valuing these assets, whether you agree with it or not, on a little bit of a less frequent cadence, that can result in less volatility within your portfolio over time. Like if you think about it, even if you're an equity manager, let's say, and instead of having your portfolio valued on a daily or intraday basis, which there's a lot of pros with doing that as well, but let's say for example that you were to value it on a monthly basis, and so you were to kind of drown out all of the performance that occurs in between, that might create a very different perception from an investor depending on what happens during the 1st and the 31st of the month, and how they view that investment or asset within their portfolio, and potentially how it works either in tandem or as a complementary piece to those other assets.
Perception meaning perhaps less likely to sell in a murky market.
Potentially, yeah. If you go through a month where you go through a significant amount of volatility and end up flat on performance, the timing as to which that portfolio is valued or that NAV is struck can have an impact on, I would say, investor psychology.
So just to go further with sort of where it provides ballast and what's for it, do alts have to beat up on bonds a bit for a place in the 40? Is that necessary?
It's potentially a place.
It's potentially a place.
As I mentioned, I think previously, is that alternatives is very wide ranging. Like you can have alternatives that possess more equity-like characteristics. Right. So much more of a risk asset.
Okay. Yep.
Much more better suited potentially to augment that portion of your portfolio. You can also have assets that are like very cash flow generative, are maybe a little bit more relative to those kind of higher octane products, a little bit more interest rate sensitive, a little bit less volatile. And in that case, maybe they're better suited, depending on the investor, of course, within that kind of more conservative or fixed income portion of your portfolio. And I think that the reason why a lot of people go first and foremost to the whole argument of, okay, let's take it out of the 40 or let's take it out of bonds, like a lot of that's recency bias. I mean, we had a
in the markets.
Yeah, I think so. Like we had a really aggressive hiking cycle, particularly within the US, but even globally to that degree, as everyone knows, over the course of the past 3 years or so, which is now kind of we've come out on the other side. But during that period, and then looking back 20 years prior to that, and the phenomenal returns that fixed income generated within someone's portfolio, it's a little bit of PTSD. And so I think the first place that they go is there. But that's not always the case. I think it all depends on, if you look at the complexion of someone's fixed income allocation, it really depends what that kind of looks like under the surface as to whether alternatives is potentially best suited to, again, augment that portion of their portfolio, or whether it's better suited as something else.
It's really interesting. Where are you noticing the most amount of expansion? You've mentioned many of the products. We're going to talk also about the new real estate trust alt that's offered here as well. But just in terms of the market itself, are you seeing a lot of these new products coming to market?
Yeah. For sure. It's been that way for a little while now. And maybe the way that I would answer that is that I think if you're someone that pays even some degree of attention to what's going on within alternatives, in Canada or abroad for that matter, I think there's the really easy stuff that people gravitate towards to look at, like, is this market growing? So it's like, what has AUM growth looked like? What do flows look like into this space? And what does that trajectory kind of play out as? There's been, as you mentioned, like a lot of product proliferation. Maybe even in some cases a little bit too much, but that's what happens when you're in a rapidly growing part of the market. I think that the less obvious kind of signals, if you will, to me in terms of growth, maybe I'll parse it into the two different areas. So within the liquid alternative industry within Canada, I think one of the biggest things to me is I look a lot at the breadth of ownership from an investor or an advisor standpoint within the country. So focusing specifically on our advice channel, when we launched our kind of first round of liquid alternative strategies in late 2020.
That long ago, was it?
Yeah, we're coming up on the 5-year anniversary in the fall, which is super exciting.
Yeah.
But at that time, it was still relatively new. The vehicle, if you will, in these types of products, at least for the retail advice channel. And so as a result of that, we probably only had, like many other manufacturers out there, like the list of dealers that owned any of our liquid alternative funds, let's call it over the first year when we launched, it was pretty small, like call it 10 to 15 dealers, largely the big banks and the independents or the investment dealers that had it a little bit more early access to some of these types of funds. But now it's like the kind of populace to which is investing in this products has grown extremely substantially. So what was maybe 15 dealers that were invested in our products in the past is now over 100.
Oh, wow.
And so I think part of that also was propelled by the introduction of CIRO in 2023. So the new self-regulatory body where some of these dealers now have individuals that have both investment fund licensees or mutual fund licensees, and they're kind of all under one roof. And so what used to be a product that was like very geared towards the old world, let's call it broker channel, is much more expansive now in terms of its use. Another kind of key thing that I've noticed is that the old world offering memorandum products that used to be hedge funds in Canada, a lot of manufacturers in Canada who are able to run those similar types of strategies, but within a liquid vehicle, so within a liquid alternative or an ETF, they've essentially cloned that and are now marketing it to mass markets. And if you actually look at flows, if you will, investment flows, kind of side by side, comparing that kind of older offering memorandum hedge fund, traditional hedge fund vehicle versus that of something liquid, it's like night and day. The liquid funds are growing like weeds, and the old offering memorandum thing is not necessarily become obsolete, but clearly investors say to themselves, you know what, if you can manage this strategy in a more liquid vehicle, I might as well access it there. And that's not the case for every product that's out there, but just something that you notice. On the private side of things,
let's go there.
There's a whole other swath of, I think, kind of signs with respect to growth. The first thing is that if you're an advisor and you invest in fund-to-fund products or you invest in balanced products, I can almost guarantee you if you pull or run a screen on the top kind of 20 to 25 balanced products in Canada by AUM, and you peel through some of their financial statements or holdings, you'll see a lot more exposure to private assets than you once did. Obviously, there's limitations in place for retail investors with regards to how much you can invest in illiquid assets, but that kind of 500 basis points wasn't there necessarily 5+ years ago. Another thing that I'll just mention on that front is the fact that there's a lot of signals with respect to these like innovative product designs that we're seeing, both in Canada and south of the border.
Okay, yeah, let's ask about it, because we've sort of understood actually from Carlos Cardone Capital Economics has a new name now, actually, but I always call it Capital Economics. Just talking about all of what you've just said, but is a lot of innovation in the U.S. I mean, do you see this as coming across the border? Do you see this as flooding the market in any way? Like, what's the impact?
Yeah, I think we're starting to see some of it. I think we've chatted before in the past about this kind of migration of alternative investment managers to different pockets of the globe to take advantage of different markets, to get away from the boom bust kind of capital raise type of approach, to get into a stream where they can potentially add value, but do so in a way that's a little bit more sticky for them over time and bring some investment capabilities that may not necessarily already exist within a portfolio.
This is people in a lot of cases.
A lot of investment managers in a lot of cases. So, I mean, you've seen a lot of these names come up in Canada. I mean, Brookfield, case in point with us, but the list goes on. KKR, Apollo,
There's
Blackstone,
others,
you name it. That's one thing. The other thing is actual like vehicles themselves. So
private credit, can you do that?
I mean, private credit.
ETF?
Private credit, they're trying to. Not in Canada. That's more so in the US. But that's a good example of like Apollo and State Street just recently launched an ETF that aims to provide exposure to private credit. And I think that they're still trying to kind of figure out some of the kinks associated with that. But what I do know is that there's a lot of smart people that are working on that. And there's a lot of folks that do want to bring that type of access to a more readily available vehicle for retail investors through that of an ETF. So yeah, lots going on in terms of like the creativity, if you will, around delivery from a product perspective.
It's fascinating. Okay, well, let's talk a little bit about what Fidelity is offering in terms of less liquid. So this is the real estate trust. You and Don Newman have discussed it quite a lot over the last little while. It's a fascinating area. This is Canadian real estate and is less liquid. Why don't we just sort of give us the broad strokes here? I would call it a real estate focused fund.
It is available to accredited investors, this vehicle that we do have. And what it does is it combines exposure to both private investments and public investments, as we've been talking about. And there's some potential kind of synergies that come along with having eggs in each one of those baskets. But if I were to explain it at a very high level, the fund focuses more so on, I would say, the private real estate side of things from a sheer exposure standpoint. So for that, we obviously have Brookfield managing those assets on our behalf, which is great.
Where are they?
They're across the country, predominantly right now in kind of primary markets. So Toronto, Montreal, Vancouver. We actually just purchased an asset, a university or student housing asset in London, Ontario. But plans to kind of go further and more broad in that sense. And that's partnered with what Don's doing and utilizing our phenomenal research team upstairs, which listed real estate in itself is actually a pretty good diversifier compared to some of the other, if you will, GIC sectors or publicly traded areas of the market. And I think that in the time that we're in right now, and we just recently launched this product, although the capability has been kind of in the works over the course of the last couple of years, at least on the private real estate side of things. And I can say this because of the fact that I'm actually trying to move myself in terms of a home, is it's a lot better to be a buyer in this market than it is to be a seller in this market. And there's some truth to that within the private world as well. And so putting that capital to work in a market where you can find some pretty interesting pricing on some great assets, hopefully bodes well for us in the future.
Okay, that's fascinating. There's some great questions kind of circling back to what we started off talking about. So we'll put these to you. Will risk ratings for alternatives potentially go down as they have longer track records? You mentioned the first ones that were launched by Fidelity, almost 5 years old.
Yeah, it's a good question. I think so. I hope so. And I say that a little bit tentatively just because of the fact that depending on the alternative you're talking about, and depending on the dealer, investment dealer in particular, that an investor may receive advice from.
Sure.
There's a varying degree of approaches with respect to how that risk rating is determined. Sometimes it's very much on the shoulders of the manufacturer, like a Fidelity. Other times it's very much incumbent upon the dealer to determine their own risk rating. I've certainly seen plenty of examples where those risk ratings have been adjusted or come down as more track record has come into play. But I can't say it's a blanketed approach across the board. So my hope is that as the hope is that as the retail audience becomes more and more familiar with these types of funds over the years, that there's more willingness to think outside the box with regards to like what actually comprises risk within a portfolio.
And so it's a story still a little bit being written for this in particular.
I think so. It's getting better, but it's still being written.
Okay, another question. Alts have been on the more expensive side of investment products with more scrutiny and maybe pressure on fees compared to before. How should we address the fee conversations with clients for these products?
Yeah, I mean, I think that, I can't speak for every product that's out there, but I think that alternatives, what they bring to the table in a lot of cases is something that is very difficult for an individual investor or even advisor for that matter
to put together.
To actually put together. So in terms of the potential access that you're gaining along with all of the potential infrastructure that actually supports that investment strategy,
which is research.
There's a conversation to be had. There's systems. There's the whole 9 yards. There's a conversation to be had around the fact that, listen, these are more kind of labor intensive, if you will, products in some ways, or can be considered that. And as a result of that, they demand a slightly higher price in order for everything to make sense in terms of the economics of a particular product. But I think the second part of that, which is probably the part that you should pay a little bit more attention to, is the continued argument of charging a price is okay, but the value has to be there.
Right.
You know, like if somebody's paying an astronomically high fee, but they're not receiving anything as a result of that, i.e. through net returns, through the type of exposure that they want to gain with that product, I think that's a conversation to be had with the investor in order to potentially identify what is or continues to be a great investment, or maybe is something you need to move on from.
Diversification is always important. It's never not been one of the key words about approaching a portfolio. This year, diversification has meant a lot of really interesting things, sometimes overseas. It's meant taking some slightly different tacks within the market and responding differently. Again, the moment for alternatives now, why is this useful versus, when diversification was talked about 10 years ago?
If you want to take the current day as the best example, you kind of just hit the nail on the head a little bit. But the last 2 or 3 months, the U.S. has stormed back pretty quickly, but we had a period of time there and on a year-to-date basis where, relatively speaking, we've had this shift to international parts of at least the equity market versus that of U.S. Some of the diversifiers, they come in and out of favor, at least those that people would think as kind of traditional diversification pieces. So
what?
The US dollar is a great example. Obviously that struggled, relatively speaking, thus far. Gold's had a really good last year or so, but it had times when you thought that it would be the diversification piece when it wasn't necessarily. 2022 is a great example of that. So my point is that even though these diversifiers have shown moments of success with regards to, it's not always a foregone conclusion. So the more you can kind of think outside the box with respect to bulletproofing a portfolio, if you will,
right.
Of which there's lots of choice and selection in terms of the types of investments, in terms of, to that question we just answered, fee structures,
sure.
You name it, there's something there for everyone.
And in the future, you just mentioned about what a rapidly expanding area of the market this is in terms of offerings, in terms of products. You going to launch any more?
That's the plan.
It is.
Yeah,
Okay.
yeah.
Can you give us any hints broadly about, okay, so you've got a long short, you've got market neutral, you've got a more value focused, you've got the Canada focus, you've got the real estate trust itself. It sounds like you've got a lot of things covered. What else is there to do?
There's lots more. There are certainly holes that we'd like to fill. We typically don't want to bring something to market if we don't think that it has the potential to be like a best-in-class product and a competitive offering out there relative to what's already available to investors. But I think that first and foremost, it's about trying to address some of these areas of the market where we don't necessarily have a solution right now. So whether that's, we've got a good little selection of products on the equity side in terms of long-short investing. We are looking at the credit side as well. We're also looking at the potential of how can we potentially package some of these solutions together so that if an investor just wants one fund that invests in this kind of curated proportion of alternatives, what potentially does that look like? On the private side of things, you mentioned the real estate piece. There's a lot of other areas and a lot of other capabilities that are either in incubation under the Fidelity umbrella or that we can potentially leverage outside of that. So if you think of areas like the infrastructures, the private credits of the world, those are the things that come to mind in terms of the hopes of getting out the door over the course of the next couple of years.
Okay, you're not sleeping. There's lots going on. There's lots of things being worked upon at this point. Let's just finish out with a couple of thoughts on the real estate trust itself.
Sure.
This is kind of fascinating, and there is a question of where it fits. So you mentioned a couple of things about how it can diversify and so on. But who is the investor who might be thinking about adding this to their portfolio, or who could they be?
Yeah, I think that if I were to try and categorize or place the products from a characteristic standpoint within someone's portfolio, it's kind of somewhere in between equities and fixed income.
Really?
Like as I mentioned previously, I think that owning high quality real estate or even owning listed real estate, it tends to be fairly cash flow generative for investors. So there's an income component associated with it. The product is valued on a monthly basis, not on a daily basis. So there's some potential smoothing effects and reduction of volatility that can help within your portfolio. But at the same time, the portfolio is investing in real estate equity. Whether that's in its physical and direct form or whether that's through a listed security. So in terms of kind of where you sit, if you will, within the capital structure or the type of, again, characteristics you might associate with equity or the return potential you might associate with that, it's slightly above that of a traditional fixed income product. So I think that to sum that all up, it certainly has the potential to be a great diversification piece, certainly has the potential to help reduce some volatility within an investor's portfolio and likely provide exposure to something that is refreshing in that it's not U.S. large cap tech.
And it's not, that's really interesting. It's very Canadian focused.
Yeah. There's some small investment outside through the liquid sleeve, but the purposes of this is to be very much a domestically focused real estate product.
And it's 30/70.
In terms of liquid and illiquid? Yeah. So we target or aim to have 70% of the portfolio invested in the private portion and 30% in the liquid portion, which means you get some benefits of the fact that we do our best to provide liquidity to investors when we need it, but also the fact that there can be sometimes some dislocation in terms of valuation between both of those markets, and Don could potentially take advantage of that.
Rory Poole, great to get the update from you. Thank you for joining us today.
Thank you, Pamela. I appreciate it.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.